on contemporary issue in monetary policy. My name is Somnazin and I'll be the moderator for this session. Today we have 4 expert panelists who will each share their perspective on some of the most important monetary policy issues of our time. These are not just textbook topics, these are real issues that have affected economic, government, and ordinary people around this world. Let me briefly introduce our panelists. First, we have Sonam Sumo, who will be presenting from the perspective of central banker, focusing on the use of unconventional monetary policy tools after the global financial crisis of 2008. Second, we have Soma Tamang, our monetary economist, who will discuss how monetary policy is used to manage financial crises. Third, we have Sonam Chezong, our financial market analyst, who will explain how monetary policy is transmitted through the economy. And finally, we have Vincent Homo, our policy critic and fintech expert, who will address the challenges facing monetary policy makers today and the impact of financial technology on the future of money. Each panelist will speak their perspective on each issues. After that, we will have an open discussion followed by a short question and answer session. I will ask follow-up questions to keep the conversation going. So let us begin with some Somo. The floor is yours.
And it's my privilege to sit here with you all. And I'm representing today as a central banker, and my focus is on the one key question, that is, when traditional monetary policy stops working, what do central banks do next? So to understand this, we need to go back to the 2008 when Lehman Brothers collapsed in September 2008. It triggered the worst financial crisis since the Great Depression. The immediate response of central bank was to cut the interest rate, but there is a limit of how far you can cut. By December 2008, the US Federal Reserve had already brought its interest rate down to the virtually zero, between 0 and 0.25%. This is called the zero lower bound. At that point, the traditional tool was exhausted. So the central bank turned to what we call unconventional monetary policy. That is, that they had been rarely using, or that they had never been used. The most of this was a quantitative easing or QE. Instead of just adjusting interest rate, the central bank directly buys financial assets, mostly the government bonds from a bank and the financial institutions. And this pump money into the financial system lowers the long-term interest rate, and they encourage banks to lend more. And the Federal Reserve launched this round of the QE between 2008 and 2014. Its balance sheet, the total value of assets it held, grew from around $900 billion before the crisis to over $4.5 trillion by 2015. The European Central Bank launched its own asset purchase worth of assets every month, and the Bank of Japan went even further. Its balance sheet eventually exceeded around 100% of Japan's entire GDP. And second, the tool was a forward guidance, where central bank publicly announces the future plans. For example, when the Fed said it would keep the interest rate low for a long time, the businesses and households felt more confident in borrowing and investing. And it is essentially the central bank making a promise to calm the market anxiety. And third tool was mainly used by the ECB and Bank of Japan, which was negative interest rate. The ECB lowered the interest rate to minus 0.1% in 2014, eventually reaching minus 0.5%. This means that the banks actually pay money at the central bank. The main aim is to push them to lend money instead. The question here is, did this tool work? The most economic research, including studies by the International Monetary Fund, concludes that the QE did lower long-term borrowing costs and prevented a much deeper recession. However, the benefits were equally felt, and asset prices rose, which benefited wealthier people more. And once the central bank balance sheets was expanded, they became very difficult to shrink, a challenge that became very clear again during the COVID-19 pandemic in 2020. And in summary, the unconventional monetary policy was necessary and partially effective response to an extraordinary crisis, but it also came with a real trade-offs.
Thank you, Kamala. That was a very thorough overview of the two available. Now, Suma, as a monetary economist, could you now walk us through how monetary policy has been used to actually manage the financial crisis?
Thank you, Hazel, for having me here today. My focus is on monetary policy as a crisis management tool. Essentially, how do central banks respond when a financial system is in danger of collapse? Let us start with 2008 global financial crisis. The root cause was a collapse in US housing market combined with complex financial product called mortgage-backed securities that had spread risk across the entire global financial system. When the housing price fell sharply, this product lost their value, and banks and neobanks faced massive losses. The interbank lending market, where banks lent to each other overnight, froze almost entirely because no bank trusted each other. This is exactly the scenario that monetary policy is designed to address. The concept of lender of last resort, originally described by the economist Walter Beckwith in 19th century, says that in the crisis, central bank must lend freely to banks that are solvent but facing a short-term liquidity problem. The goal is to stop panic from turning into a full system collapse. The Federal Reserve did exactly this in 2008 financial crisis. It created an emergency lending facility, for example, the term auction facility and primary dealer credit facility, to inject the liquidity directly in struggling financial institution. It also supported the takeover of failing investment bank, Bear Stearns, and played a major role in the bailout of insurance giant AIG, which was deeply connected to the financial system. Fast forward to 2020, when COVID-19 hit, the economies around the world effectively shut down within the weeks. The monetary policy response was faster and larger than anything seen in 2008. The Federal Reserve cut the rate to zero in March 2020 and launched unlimited asset purchases. It introduced entirely new tools, including direct purchases of corporate bonds, something it had never done before. ECB launched a pandemic emergency purchase program within a total envelope of 1.85 trillion euros. However, there is an important concern that economists raise called moral hazard. Like when banks and financial institutions know that the central bank will always rescue them in the crisis, they may take too much risk because they believe they will be protected. This is sometimes called too big to fail problem. The challenge for monetary authorities to provide stability without encouraging reckless behavior in the future. In conclusion, monetary policy has been proven to be a powerful and rapid tool for stabilizing financial system during the crisis, but it works best when combined with strong financial regulation and, importantly, when fiscal policy support from government.
Thank you so much. That helped us understand how policy is deployed in the crisis. Now, Sonam Chezo, as our financial market analyst, can you help us understand how monetary policy decisions actually reach household and business, what we call the transmission mechanism?
Thank you, Hazel, for having me here. So I want to tackle a question that often gets overlooked. Monetary policy decisions are made in central banks, but how do those decisions actually affect ordinary people, business, and broader economy? This journey from policy decision to real-world impact is called the monetary transmission mechanism. So think of it this way. So when a central bank changes interest rate or launches a new policy, that decision does not instantly change economic behavior. So it travels through the economy through several different channels like water flowing through different pipes. First and most well-known is the interest rate channels. When central bank lowers policy rate, commercial banks typically lower their own lending rates. So this makes mortgages cheaper, business loans cheaper, and credit card rates lower. As a result, households borrow more, spend more, and business invest more. So this stimulates the economic activity, conversely raising rates cool down the economy. Second is credit channel. This is slightly more complex. Even if interest rate falls, banks may still be unwilling to lend, particularly in a crisis. So if they are worried about borrowers defaulting, the credit channel recognizes the availability of credit, not just its price matters. After 2008, even with the near zero interest rate, lending fell because banks were repairing their balance sheets. So this is why conventional cuts alone were insufficient. Third is the asset price channel. When interest rates fall, so existing financial assets like bond and equities become more attractive, so their prices rise. Rising equity prices increases the wealth of shareholders who may then spend more. This is the wealth effect. So companies with higher share prices also find it easier and cheaper to raise capital for investment. Fourth, the exchange rate channel. Lower interest rate makes the country's currency less attractive to foreign investors seeking returns, so the currency tends to depreciate. So a weaker currency makes export cheaper for foreign buyers, boosting export demand. So Japan and Eurozone have both benefited from this effect following their QE programs. Fifth is the expectation channel. So this is perhaps the most powerful and least tangible. So if people and businesses expect the central bank to keep inflation low and stable, so they make decisions accordingly, negotiating moderate wage increases, setting moderate prices. So this creates a self-fulfilling stability. So central bank credibility, we believe, is therefore essential. Understanding these channels helps us explain why unconventional tools like QE were needed. So when interest rate channels were blocked at a zero level bound, central banks had to stimulate the economy through the asset price and expectation channels instead.
Thank you, Sona. That was a very helpful breakdown of how monetary policy travels through the economy. And finally, we have Tin Sohamu. You will perhaps have the broadcast brief today covering both the challenges facing monetary policy makers and the future of monetary policy in the digital age. Please go ahead.
Thank you, Hazan. So my presentation addresses two interconnected things. First, I will discuss the constraints and challenges that makes monetary policy difficult in practice, and then I will examine how financial technologies in fact is beginning to reshape the very foundations of monetary policy. Beginning with the challenges, the most fundamental tension in monetary policy is inflation versus growth rate. Central banks are typically tasked with maintaining price stability, controlling inflation, while also subverting economic growth and employment. So these objectives can directly conflict. If a central bank raises interest rates to control inflation, if risks slowing the economy and increasing unemployment, if it keeps the rates low to support growth, it risks inflation rising beyond a manageable level, and this dilemma was vividly illustrated between 2021 and 2023, when the Federal Reserve faced its highest inflation in over 40 years, reaching 9.1% in the United States in June 2022, and was forced to raise interest rate at the fastest pace since 1980, from near zero to over 5.2%, risking a recession in this process. So a second challenge is central bank independence. So in theory, monetary policy should be insulated from short-term political pressures. Politicians facing elections prefer lower interest rates and economic stimulus. But central bankers sometimes make unpopular decisions like rising rates for long-term stability when government pressures central bank to act in politically convenient way. It undermines credibility and can lead to higher inflation expectations. This has been observed in Turkey, where political interference in central bank decisions contributed to serious currency crisis in 2021 and 2022. And third challenge is liquidity trap, a concept introduced by economist John Maynard Keynes. When interest rates are already near zero, cutting them further has little effect because people prefer to hold cash rather than invest. So Japan experienced this for most of the 1990s and 2000s despite aggressive monetary easing, and this demonstrates that monetary policy alone cannot always restore economic growth. So now turning to the future, financial technology. Financial technology is not just changing how we pay for things, it is challenging the very structure of monetary policy, considering cryptocurrencies like Bitcoin and Ethereum. These are decentralized digital currencies that operate outside the control of the central bank, and as they grow in adoption, they reduce the proportion of transactions that monetary policy can influence. In response, many central banks are developing central bank digital currencies like CBDCs. A CBDC is a digital form of a country's official currency and issued directly by the central bank. And China has already launched the digital yuan with hundreds of millions of transactions recorded. And the European Central Bank is piloting a digital euro, and CBDCs could significantly improve the transmission of monetary policy. For example, a central bank could apply negative interest rate directly to digital cash holdings or deposit stimulus payment instantly into every citizen's digital wallet. However, CBDCs also raise serious concerns, including financial privacy, the risks of bank disintermediation, and cybersecurity vulnerabilities. And financial inclusion is another dimension. Digital payment systems benefit those with smartphones and internet access, but may exclude the elderly and rural populations. So, in summary, monetary policy makers today face an environment of greater complexity, politically, economically, and technologically, and than at the previous point in modern history. The institutions and frameworks that serve in the 20th century will need to evolve significantly to remain effective.
Thank you to all four of the panelists. That was a rich set of perspectives. Now I would like to discuss some of these ideas together, because in reality these topics do not sit in separate boxes. They are deeply connected. I will ask few questions to get us going. So you argued that the quantitative easing worked, but Keynesian has pointed out that unconventional policy can create problems like asset price inflation. How do you respond to that?
That is a fair point, and I will not deny it. Quantitative easing did push up the asset prices, stock and property, which benefited the wealthier households more than the low-income ones. But I would argue we have to think about the alternatives. Without the quantitative easing in 2008, we likely would have seen a bank failures on a most massive scale, millions of job losses and a deeper depression. The issue is not whether the quantitative easing was perfect, as it clearly had a limitation, and whether quantitative easing was perfect, as it clearly had limitations. The key consideration is whether it was more effective than taking no action at all. In this regard, the majority of economists agree that quantitative easing was a necessary and beneficial policy response. So I think that is probably right, but it also illustrates a structural problem. And when emergency tools become standard tools, and when the market starts expecting central bank supports every time there is a downturn, and when economics call the central bank put, it creates long-term fragility. We need to be honest that quantitative easing has consequences beyond the immediate crisis.
Thank you to both of you. Soma, you mentioned about the moral hazard, the idea that banks take more risks if they know they will be rescued. Does that mean central banks should sometimes let banks fail?
This is one of the most difficult questions in monetary policy. In theory, yes, when some institutions fail to send a signal that risky behavior has consequences. In practice, it is far more complicated. When Lehman Brothers was able to fail in 2008, it triggered a global panic that was arguably worse than any alternative. The problem is interconnectedness. A major bank's failure can take down other institutions that have no part in risky behavior. So central banks often rescue the institution they would prefer not to, simply to protect the wider system.
And this connects directly to the credit channel I discussed. If bank fails or becomes too cautious, credit dries up entirely, which is devastating for small businesses and households who depend on loans. So the transmission mechanism breaks down completely, and that is why maintaining banking system stability is a precondition for monetary policy to work at all.
Sonam, you mentioned about the exchange rate channel that boosts monetary policy weakens the currency and boosts export. But if every country does this at the same time, what happens?
That's an excellent question. So that scenario is known as quantitative devaluation, sometimes called the currency war. So if the US cuts rates and weakens the dollar, and then the ECB does the same to weaken the euro and so on, the relative exchange rate effects cancel out. So no single country gains on competitive advantage, but all of them have loosened monetary policy significantly. The concern is that this could create excess liquidity globally, fueling asset price bubbles of inflation. So the 2010 to 2015 period saw real fear about this as major central banks all pursued quantitative easing simultaneously.
Moving to Keynesian, you mentioned that CBDCs as a future tool, but could a CBDC actually make monetary policy more powerful, or could it introduce new risks?
So thank you for the question. So both potentially. On the positive side, the CBDC would give central bank a direct channel to households, bypassing the banking systems. And in a crisis, stimulus payment could be transferred instantly, and negative interest rate could be applied more precisely. The expectation channel would become much more direct, but the risks are real. So if people hold money directly with the central bank through a CBDC, they might withdraw deposit from commercial banks during a crisis, and a digital bank run that could happen in a minute rather than days. So this is called disintermediation, and the central bank would need entirely new frameworks to manage this, and it is a powerful tool but two-edged one.
Thank you, everyone. These are very thought-provoking points. It is clear that monetary policy operates in a complex environment where every action has intended and unintended consequences. Now let us move to our question and answer session.
My question is to the central banker. In the simple terms, what is the difference between the normal monetary policy and quantitative easing?
Thank you for the question. The normal monetary policy is like adjusting the speed of a car using the accelerator. You raise or lower the short-term interest rate, and the quantitative easing is what you do when the accelerator stops working, when rates are already at zero. Instead of just signaling, the central bank actually goes into the financial market and buys bond directly, and this pumps the money into the system and pushes down the long-term interest rates that affect things like mortgages and business loans. So the normal policy works through the signal and the quantitative easing works through the direct actions.
My question is to the monetary economics. The term lender of last resort came up, so could you please explain it in a simple term?
Thank you for your question. Imagine a bank is fundamentally healthy, but for some reason, maybe panic in the market, it suddenly cannot access short-term funding. Without help, it would have to close its door, which would hurt all its customers and possibly trigger a wider panic. The lender of last resort, which is the central bank, steps in and lend that bank the money it needs to survive the panic. The key condition, as the economist Walter Beckhart put it, is to lend freely but penalty rate and only to banks that are genuinely solvent, not just rescuing badly managed institutions from their own poor decision. Thank you.
My question is for the financial market analyst. Which of the 5 transmission channels do you think is most important and why?
For your question, I would say the expectation channel is the most important. All the other channels, interest rate, credit, asset prices, exchange rate, depend on people and businesses changing their behavior. But whether they do that depends enormously on what they expect to happen in the future. So if the business expect stable inflation and steady interest rate, it will invest confidently. But if expect instability, it will hold back even if current states are low. So the central bank credibility being trusted and believed underpins the effectiveness of every other channel. So this is why the events like the central bank suddenly changing courses unexpectedly can be so damaging.
My question is, do you think cryptocurrency like Bitcoin could ever replace the traditional money?
Thank you for the wonderful question. So it is an interesting possibility, but I think very unlikely in the near future for a few key reasons. For Bitcoin, it's extremely volatile. Its value can swing to 20% to 30% in a matter of a day. And that make it a very good medium of exchange because you cannot reliably price goods in it. So second, most governments and legal systems still require taxes and debt to be paid in official currencies. So official money retains a fundamental role. And third, Bitcoin is not controlled by any government, which means the central bank can use it as a tool to manage the economy. It might coexist with the official currency as a store of value or speculative assets, but replacing sovereign money would require overcoming enormous political, legal, and practical barriers. Thank you.
And with that, we bring this panel discussion to a close. Allow me to briefly summarize what we have covered in this panel discussion. Sonam Somawat showed us that when conventionally monetary policy reaches its limit, central banks turn to unconventional tools like quantitative easing for guidance and negative interest rate tools that have been used in an unprecedented scale since 2008. Soma explained the role of monetary policy in managing financial crisis from the lender of last resort, functioning during 2008 to the rapid intervention of 2020, while also questioning us about the moral hazard these rescues can create. Sonam Chilom walked us through the 5 channels through which monetary policy reaches to the real economy, which is interest rate, credit, asset price, exchange rate, and the expectation, and explained why these channels is essential to understanding and why policy sometimes works and sometimes does not. And Tenzin gave us a critical and forward-looking perspective highlighting the real tension between inflation control and the growth, the importance of central bank independence, and the exciting but challenging possibilities that financial technology and central bank digital currency are opening up. This discussion made clear is that monetary policy is not simple off and off switch. It is a complex, powerful, and imperfect set of tools operating in an uncertain world. The challenge for monetary policy makers now and in the future is to use these tools wisely, transparently, and in the public interest. Thank you to our panelists and all the audience. This concludes our panel discussion.